welcome everybody. A lot going on. I was chatting with Mark a bit here before we hit high noon Eastern time, and I'll be giving you more information on this next week rather. But it seems now the Russian central bank has tied the ruble to gold at a rate of 5,000 rubles per gram. So we may now have our first currency with at least an indirect link to gold. I am just starting to dig into that story, so more on it next week. That would be a big development, though, and I talk more about it in the Portfolio Watch newsletter, stating that we were leading up to something big, and now it seems like that may have happened. So check out your Portfolio Watch newsletter you'll get tonight. I will have more information on that for you next week. As I go through the material today, if you have a question, there's a chat box. Type your comment box to be specific. On the right-hand side of the screen, go ahead and type in your questions or comments there, and I'll monitor that as we go through the material today. That said, let me go ahead and jump in. I want to talk about a couple things briefly, and then another topic in depth. Consumer sentiment is now the lowest in a decade. The yield curve has now inverted, and there has never been a recession without an inverted yield curve preceding the recession. Now, I told everyone here about a month ago that it was my belief that the U.S. is now in a recession. Now the yield curve has inverted. I believe as the numbers are revised backward that may indeed be the case. And history tells us how this movie, if you want to use that term, that we're watching ends. And I talked about this a bit on a prior Headline Roundup webinar. I want to dig into it and talk about it today in a little more depth. But let me begin with the consumer sentiment piece. The most recent University of Michigan Consumer Sentiment Index, which was for the month of February, clocked in at 62.8. Now, there is a chart on this slide taken from the article that really illustrates this nicely. That is the lowest level since 2011. And if you go back and think about what happened in 2011, we were just getting through the global financial crisis. And this is a reading that is typically seen only during a recession. So as inflation is now accelerating, as inflation is becoming more intense, we have the economy now, it seems to be slowing. So we're moving toward that stagflationary outcome that we thought we might see. Now, the article said we're not in a recession by any conventional definition, but it's clear that inflation is really getting to people, and that will be news to a Fed that's been calling for inflation overshoots for years, because its arbitrary inflation calculation was a rounding error below its arbitrary 2% inflation target after the global financial crisis. So in other words, the Fed has been saying we want to exceed our 2% target. The 2% target, the article correctly says, is arbitrary. It was chosen by the Fed as a target. We are now well in excess of that target. In fact, as inflation started to accelerate, as we pointed out on past webinars here, the narrative has changed a lot. We initially saw the Fed change the way inflation was reported. They then took a look at changing the 2% number to an average over time, which would, in their words, allow inflation to run hotter for a period of time. When inflation did run harder for a while, they said that the inflation we were seeing was transitory. That was then changed to persistent. And now, as I pointed out last week, Janet Yellen says we're going to see uncomfortably high inflation for at least the next year. Now, the yield curve has inverted. And as I said, really since World War II, there has never been a recession unless there's been an inverted yield curve first. Now, based on my research, you can have an inverted yield curve without a recession, but there's never been a recession without a yield curve inversion preceding it. This article came from Fox Business, and it starts by saying a closely watched recession predictor in the bond market just flashed red, spurring fresh concern that the U.S. economy is on track for a downturn this year. The spread between the 2-year and 10-year Treasury yields inverted on Tuesday, which means that a 2-year Treasury yield exceeded the yield on a 10-year Treasury. That hasn't happened in 3 years. The article says that inversion occurred on fears that the Federal Reserve's aggressive approach to tackling the hottest inflation in 4 decades could lead to sustained slowdown in growth. Now, I would argue that the Federal Reserve is not taking an aggressive approach to inflation. The small rate increase that we saw is, as I talked about in my interview with Gary Schilling recently, the equivalent of using a garden hose on a forest fire. And if you listen to the interview, you know that Gary appreciated that analogy. Well, the yields on the 2-year Treasury climbed to just under 2.4%, 30 years, 2.38. So again, the 2-year and 30-year yielding about the same. So the spread between the 5 and 10-year and the 2 and the 30-year are now inverted. The article explains that yield curve inversions, which are rare, are viewed as a good recession predictor because it suggests that investors believe with the interest rate on long-term bonds lower than the interest rate on short-term bonds, economic growth is slowing. There's an article here from Anu Gagar, who is a global investment strategist for Commonwealth Financial Network, who said, markets are fixated on the U.S. Treasury curve as it is considered an excellent gauge of the economy. If the economy is healthy and growing, longer-term Treasury rates should be higher than shorter-term rates. When the reverse happens, concerns start to mount about the future state of the economy. Now, the topic I really want to dig into this month, and I have about 10 more slides than normal to be able to talk about this topic in some depth, in some detail. And I titled this section, History Tells Us How This Movie Ends, because this history does repeat itself. We had inflation and price controls in the 1940s. We had inflation and price controls in the 1970s. Here we are in 2022, and we have inflation. And I believe that since we're heading into an election year, we are in an election year, actually heading toward an election, I should say, that we may see politicians be politically expedient without necessarily being economically efficient. Global central banks are, and I should point out also, this article was from last fall, but I thought it did an excellent job of outlining what's happened in the past and why we might end up there again. Central banks globally are fighting the deleveraging. Well, deleveraging is simply getting rid of debt. When you get rid of debt through deleveraging, and the way that happens is debtors either pay down their debt by making principal and interest payments, or they elect to default on the debt. We have the largest debt bubble in modern history. Worldwide, as I reported in the past, we have debt totaling about $300 trillion. That's all private sector debt and all public sector debt. With inflation recently hitting its highest levels in 30 years, I would say 40 years even, many have called for more responsible policy decisions from central banks to tame the inflation that's now ravaging the everyday person. But the problem with that, as we've talked about here in the past, is that you cannot balance you cannot get inflation under control and quit creating currency unless the federal government is operating with a balanced budget. And we're not even close to that. When central banks started to taper in 2018, assets began cratering. We saw stocks crash. We saw real estate start to sputter. So the article correctly points out that central banks like the Federal Reserve, like the European Central Bank, are globally stuck between a rock and a hard place. If they continue to print and run enormous fiscal deficits, all they're doing is throwing gas on the inflation fire. On the other hand, if they stop printing and they raise interest rates, assets begin to sell off. So central banks, I believe, are out of options in trying to combat this economic conundrum. And now to complicate things, we seem to have Russia with some cooperation from China now tying their currency to gold. That's going to really complicate things. Now, the article says, do they have a nuclear plan hidden up their sleeves they're about to unleash, making the unprecedented 2020 balance sheet expansion look trivial in comparison? I already kind of gave away what this nuclear option might be. Now, the article says, before you look at this nuclear solution, why is deleveraging simply not an option? Why can the Fed not be complicit in federal deficit spending, which is what it would really take to begin this deleveraging process? Well, as we already discussed, the world has never been more indebted than it is today. And central banks are trying desperately to repeat what happened in the 1930s, which was the article says, a mass deleveraging event. It was a major deflationary event. The Dow Jones corrected 90%. After that initial correction, as the deleveraging process played out, unemployment was extremely high for a decade, and there was a lot of misery. Now, if you take a look at this chart, this is a chart of what the Dow Jones Industrial Average did starting in 1929, and you can see it's a 90% decline. That is what central banks want to avoid. Now, Hirschman Capital, and this is a really important statistic, because you can change the narrative, but you can't change reality. Hirschman Capital released a report which explains the predicament that central banks are actually in. It went all the way back to the year 1800. And in that time frame, 220 years, 51 out of 52 countries that reached debt levels greater than 130% of their GDP or their economic production, they ended up defaulting on their debts within 15 years. How do they default? Through devaluation. They created currency and devalued the currency in order to pay off the debt with currency that had the purchasing power that was just a fraction of the purchasing power of that same currency when the debt was incurred. Devaluation is essentially inflation. They restructured the debt, saying, I can't pay you over the next 10 years, but I can pay you over the next 50. Or they just said, forget it, I'm not going to pay you. They just defaulted. So that was seen in 1971 during the Nixon shock, when the U.S. refused to make good on its obligations to allow countries to redeem the U.S. dollar for gold. Well, now here we are 51 years later, and it seems now that another country is putting their toe in the water and backing their currency by something tangible. Now, central banks usually say, no problem, let's just create some currency. And they default through inflation and currency devaluation. And that's what we're seeing going on around the world now. And that's what's fueling inflation. Now, the picture you see on this slide is one that you've probably seen before. It represents how many German marks it took to buy groceries during the hyperinflation after World War I. But here's the bad news. The U.S. now has passed this 130% debt to GDP ratio. The prior time in history the U.S. had debt levels as high as today was in the 1940s. However, that was after financing World War II. So if you take a look at this cycle, and there's a number of economists out there that all analyze these cycles, and they all kind of end up at the same place. Ian Gordon, a past guest on the radio program, talks about the Kondratiev wave cycle. This particular cycle is called a leveraging depression reflation cycle. And you see that it takes a long time for debt to build up to a point that it's unsustainable. In this case, 50 years or more. In 2 or 3 years, you go through a depression as debt can't get paid. and then you have a reflationary time frame. That's just to get you back to where you roughly started. So that's where we're headed, and that's what central banks are trying to avoid, and avoid like the plague, to use an old term. So if you take a look at this chart, and I would go back and look at this webinar again, and it's very hard to get a chart that has this much detail printed in such a way that you can see everything that's on there. But if you take a look at the fact that central banks pegged interest rates for about 2.5% for the best part of a decade, and that's really, if you take a look at this chart that starts in 1920 and goes to 2020, you see that's really what allowed the U.S. to run up really big fiscal deficits. So if you look here during this time frame of 29 through the end of World War II into, say, 1950 or so, interest rates remained very low. And then you saw the monetary base as a percentage of GDP. You saw the monetary base increase until it got to the point that debt was unsustainable. Now, if you take a look at the inflationary periods, that whole thing caused significant inflation in the 40s. We saw significant inflation again in the 70s, and now we're seeing it again now. So my point today is that history does repeat itself, and if we pay attention, we know what the inevitable outcome will be. We just maybe don't know the when. So if you take a look at this chart, you see that debt as a percentage of GDP really peaked at 120% at the end of the Roosevelt and beginning of the Truman administration. We are now back at 130%. But if you take a look at what happened in the 1940s, the article asks a very good question. Is that what we're looking at again today? Because again, history does repeat itself. Now, the International Monetary Fund, which many of you recognize as the central bank of central banks, wrote a working paper in 2015 titled The Liquidation of Government Debt. This paper was really a blueprint, to use that term again, that would show how central banks would inflate away the debt similarly to what was done in the 1940s. And every time now that they try to tell the market they're not going to inflate away the debt, then we see assets start to decline. And I think that's what we'll see if the Fed continues with this taper, which I believe they will not. So Jerome Powell, the chair of the Fed, has said that by June of 2022, they're going to quit creating currency. However, as Peter Schiff recently pointed out, in the week after the Fed raised interest rates by 0.25%, their balance sheet grew, meaning that they're still creating currency. And they have to, because it's the only way the government deficit will get financed. So if you take a look at this chart, this shows you what stocks did the last time the Fed started to taper. The market sold off about 22% 2 months into the taper, and here we are weeks into the taper now. And the article author says, wait, you can't taper a Ponzi scheme. I mean, we've created currency to pay down debt. We've created currency to mask the effects of debt. And what we have now is an artificial environment. So the stock markets are, in my view, almost entirely reliant upon stimulus to remain elevated at these levels. And I believe stocks and I believe real estate will likely now start to react negatively should the Fed continue down this road. And I believe the Fed will reverse course. But now we have this other variable with a global currency and a huge natural resources exporter now tying their currency to gold. So that's going to complicate things. Hopefully, we can all hope it doesn't complicate things and create more geopolitical tensions than we're now seeing. So in 2020, another example here, we take a look at what the S&P 500 did, and we take a look at how fast the market declined 30%. In 2020, before there was massive government stimulus, when all these relief packages were passed, and the Fed then started to, since that time, the Fed has increased the monetary base by over 40%. But when the market started to unravel in early 2020, it was the fastest 30% crash in history. And as I said, the response was, wow, we're going to really bail out this economy. We need to respond to COVID. And the CARES Act was passed, and there were other stimulus packages passed, and they were all funded through newly created currency, creating a market that was even more artificial. So now we're 51 years after what this article refers to as the Nixon shock. And now I believe that we have just experienced maybe another shock, which occurred after I put this presentation together. For those of you that want to do a little bit of research, you could do a search for Zoltan Pozsar, Zoltanpozsar. He is a former Fed member and a monetary consultant who calls what Russia just did Bretton Woods 3. So we have significant inflation, but if we see a lot of exporters now demand that importers pay for imports in gold or in that particular country's currency, we're going to see massive inflation, even more massive inflation than we've already seen in the US dollar, because these countries will have no reason to inventory US dollars. And I think we're maybe getting close to that at this point. Now, we're now also seeing empty shelves. And one of the concerns is that, and I talked about this in the 70s as it related to what Nixon did, one of the concerns is that politicians feeling political pressure to deal with inflation decide to put in place price controls. Price controls lead to even more empty store shelves, and we're starting to see those now. There are those that say that supply shortages are causing inflation, but the reality is inflation causes supply shortages. If your production time for a particular product is a period of months, and during that time frame, inflation is causing your input costs to go up significantly, you're probably not going to produce that unless you know you can produce it for a profit. So Mark did post Zoltan Pozsar's name in the chat for those of you that want to check it out and do some research between now and next week. So are we going to see a repeat of what we saw in the 40s or 70s? We had food rationing, we had energy rationing. So let's dig into what actually happened there. In the 1940s, we saw inflation over a 10-year time frame increase at 76.4%. That's 5.9% annualized inflation. The highest year was from 46 to 47 when inflation was 18%. And the chart shows you what inflation looked like in the 40s. If you use that same inflation methodology to calculate the inflation rate today, the inflation rate today is much higher than it was in the 1940s. Now, food from 41 to 51 was the component in this consumer price index basket that was affected the most. In today's CPI calculation, food is not included in the calculation. But you can see on a year-to-year basis what annualized inflation was during the 1940s. So in response to the annualized inflation, the central planners did what central planners do according to the article. They set up a bureaucracy. It was called the Office of Price Administration. And this agency was forced to oversee price controls and saw its powers extended and expanded in October of that year with the passage of the Emergency Stabilization Act. So what happened? Inflation was becoming out of control. The populace was becoming restless. The populace was demanding that politically something be done. So the politicians did what politicians do. They set up the Office of Price Administration, and they expanded the powers through an Emergency Stabilization Act. So what did they do? Well, they began rationing. They rationed gasoline. In fact, you see that here was the food ration for a week for one adult. You got one egg, you got 8 ounces of sugar, you got 2 ounces of cheese, you could get 2 ounces of tea, 2 to 3 pints of milk, 4 ounces of margarine, 4 ounces of cooking fat, and 2 ounces of butter. And along with that, you could get a pound of preserves every 2 months. If you like jelly on your toast, you better be careful. You could get 12 ounces of sweets every 4 weeks, and 4 ounces of bacon or ham. And there was a point system that was put together. And if you want to learn more, you can go to the 1940sexperiment.com. I don't need to tell you that it ended poorly. So again, in the 40s, politicians started to do what politicians always do. As I've always said, human behavior is predictable, but the collective behavior of groups of politicians is even more predictable. Automobiles and radios were taken out of the index, and the items that were left in the consumer price index basket, the inflation calculation was heavily manipulated. Shrinkflation was rampant in the 40s, as it is today. The CPI index changed the size of a box of cornflakes from 8 ounces to 6 ounces. In other words, the bureaucrats said, cornflakes are getting too expensive. Let's not price an 8-ounce box. Let's price a 6-ounce box. It'll make inflation, the reported inflation number, look more favorable, but it obviously didn't change the real inflation rate. You only had 6 ounces of cornflakes instead of 8. Many automobile measurements were changed to try and hide the inflation that the public felt during this period. The price controls were temporarily lifted in 46, but inflation raged, so they kicked them back in again in 51. Here's the point. When price controls were implemented, it only led to food shortages. Producers had no incentive to produce large crops when their profits were cut, and more pain was felt by the consumer as a result. In other words, you're not going to go grow corn unless you think you can make a fair profit by growing corn. So what do? You grow something else. That's happening now. Corn producers are, in many cases, when they can find the seed, growing soybeans instead of corn. Soybeans don't require the same level of fertilizer to get a crop. Well, what is that going to mean for this fall? I believe it's going to mean that any product that has corn in, and there's many, many products with corn in, we're going to see shortages. Why did inflation dissipate in the early 50s? The Fed finally said, wait a minute, we've got to quit creating currency. They tightened monetary policy. That's the only way inflation gets fixed. And again, that can't happen today unless the federal government operates with a balanced budget. Now, the same thing happened in the 70s. So Nixon won re-election in 72 because one of his promises was that he was going to implement price controls. We're going to stop the greedy corporations. We're going to slow down inflation. And Nixon, in 1971, introduced a 90-day price freeze on all wages and prices in the economy. Well, that didn't work either. So the 40s and the 70s have heavy parallels to today. And if you take a look at the 40s on the 70s on this chart, you see that energy costs were rising in the 70s, basically oil, and in the 40s, it was food. An example, in 1973, gasoline consumption by the city of Tulsa vehicles was cut more than 25% to preserve gasoline, and some workers lost their vehicle take-home privileges. Light bulbs were removed from corporate buildings, leaving workers in the dark. Speed limits were lowered to 55 miles an hour. You don't burn as much fuel at 55 as you do at 70. And only the police and fire departments were exempt from rationing, leaving everyone else fighting over the limited supply. Now, in the 70s, price controls, so several examples here, but one, price controls on chicken coupled with the rising cost of chicken feed meant that if farmers decided to raise chickens, they were going to lose money. So what did farmers decide to do? What any businessman would do, they decided not to lose money. And incidentally, these were not all big, greedy corporations. Many of these were family poultry farms. So at that time, and again, in the interest of time, I won't spend a lot more time on this, but again, they changed how the consumer price index was calculated again. We're seeing this all happen now. So bottom line is this: price controls, new bureaucracies. In both cases, inflation wasn't stopped. What happened in both cases was we had shortages and black markets became dominant. I will tell you now, because the statute of limitations has expired. In the 1940s, my grandfather, who happened to be a farmer, got access to gas. So he would fill up all the family vehicles with gas and take his gas stamps to town and trade them for flour and sugar. It was a black market. I know from firsthand experience, hearing the stories, that that's what happened. The only thing that tamed inflation from the 70s was the same thing that tamed it going into the 1950s, and that was more responsible monetary policy. You just can't create currency in unlimited amounts without bad things happening. And as you all know, if you've been a long-time listener to these updates, Paul Volcker raised interest rates to 20% in 1981, and it did slow inflation and things got back under control. So the bottom line is this: what stopped inflation in the 40s and the 70s? They stopped currency creation. Price controls make the problem worse. Now, we've seen some price controls already. We had rent controls, we've had rent moratoriums, we've got student loan moratoriums. The student loan payment still don't have to be made. That's been now kicked down the road. They're talking about kicking it down the road again. We haven't felt the effects of all these. There are rent controls now in place in Oregon and California. We have price controls in place. But the bottom line is this: central banks, and this article writer got it right, central banks claim their interference with the free market helps to smooth the business cycle. But when you look at that chart, that's certainly not the case. The left-hand side of the chart starts in 1800, shortly after the Mint Act of 1792, and goes through 1913 when the Federal Reserve was formed. The left-hand side of the chart, we were on a gold standard, and if you want to look at a smooth business cycle, the left-hand side of the chart looks fairly smooth. And what we're looking at here is the Dow to gold ratio. So it's the price of stocks priced in gold. Pricing them in US dollars is not a really good metric because the US dollar has lost a lot of purchasing power. Look at the right-hand side of the chart. It's far from smoothing the business cycle. It makes the business cycle more volatile. It creates boom and bust cycles, and that's exactly what has happened. Ludwig von Mises, who I've talked about frequently here, has a very important quote that you should file away. There's no means avoiding the financial collapse of a boom brought about by credit expansion. You could rephrase that. There's no means of avoiding the financial collapse of a boom brought on by currency creation. It means exactly the same thing. The alternative is only whether the crisis should come sooner as a result of a voluntary abandonment of further credit expansion. In other words, do you just want to take your lumps and quit creating currency, or will this crisis come later because no one adapted responsible monetary policies and we've got a currency crisis? So in the 40s and in the 70s, the policymakers said, okay, we need to have responsible monetary policy. We have to hope that that will happen again. And now we may be a little bit closer, to use another analogy of the rubber actually meeting the road now, with the ruble being tied to gold. So which will it be? Well, we don't know for sure. And that's why we talk about making sure that in your portfolio, you've got a good inflation hedge and a good deflation hedge. And certainly now, if you don't have up to 20% of your portfolio in physical metals, I think given the developments of this last week, and I'll give you some updates next week, it's important for you to seriously consider that to see if it's right for your situation. Now, von Mises said this, and I think this is very, very relevant to where we are today. The course of a progressing inflation is this. At the beginning, the inflow of additional money makes the prices of some commodities and services rise. There are still people in the country who have not yet become aware of the fact that they are confronted with a price revolution, which will finally result in a considerable rise of all prices. These people still believe that prices one day will drop. Waiting for this day, they restrict their purchases and they increase their cash holdings. But then, finally, the masses wake up. They become suddenly aware of the fact that inflation is a deliberate policy and will go on endlessly. A breakdown occurs and the crack up boom appears. Everybody is so anxious to swap his money against real goods, no matter whether he needs them or not, no matter how much money he has to pay for them. Within a very short time, within a few weeks or even days, the things that were used as money are no longer used as media of exchange. They become scrap paper. Nobody wants to give away anything against them. So here is the progression. In my terms, we have hard money. Hard money then is transformed into a fiat currency. We have a long period of time where we have deficit spending and debt accumulation. Then we have currency creation to cover deficit spending, which has been happening at an ever-increasing rate since 2011. During this time frame, we have additional debt accumulation. Then we have more currency creation. Then we have accelerating inflation. Then we have supply shortages. Then the narrative changes to blame inflation on anything but the real cause. We get price controls, shortages intensify, and we finally have a crack up boom unless responsible monetary policies are adopted. So history does repeat itself. It happened in the 40s, it happened in the 70s. And again, in both of those cases, we had a Federal Reserve that said, wait a minute, we need to stop this. We need to adopt responsible monetary policies. I believe today is different. And I believe it's different because, as I pointed out, the United States government now has debt to GDP in excess of 130%. And we know 51 out of 52 times that eventually that debt is defaulted upon. And now with a currency in the world being tied to gold, and again, I'll get you more details on it next week, that day may be getting closer. So I know I'm a bit over here today, but a lot going on here. I hope that was helpful and give you some ideas to what to expect. But again, the big thing I want to point out is that moving more towards tangible in 20% of your portfolio, I think for many people is going to be really important. If you want to talk about it, give the office a call at 866-921-3613. Be glad to chat with you about it. Mark, I'm coming up on 40 minutes here today, and I'm not seeing any questions, but I'll hang out just a minute in case there are some. Jeff, gold only or all precious metals? Jeff, I got all precious metals is probably the answer I would give there. I would probably be looking at gold and silver primarily for most people. For many people, if you can handle a little bit of volatility, I would go 50% gold, 50% silver. That's rule of thumb. We should talk about it for your individual situation. I think that silver is potentially a better upside opportunity at this point. That gold to silver ratio now is about at 70, which is a lot higher than it has been normally. Silver is an industrial metal and a monetary metal. It's also used in the green movement. So I like having some silver also. So good question. Jeff gets an A for participation today. All right, we'll be back again live next week. Thank you guys for tuning in.